If you have $100 to spare right now, you can start investing. Because investing isn't about how much you start with, it's about how early and how consistently you build the habit. When I first got serious about money, I only focused on saving. But soon, I realized my savings weren't growing fast enough to keep up with inflation or the lifestyle I wanted. That's when it clicked. Saving makes you comfortable, but investing makes you wealthy. In this video, I'll break down Investing 101 for beginners in simple terms with examples and from my own experience. Stick around till the end because I will also share my actual portfolio. Hi and welcome back to my channel. Here's a little self-intro. Hi, I'm Cici and I'm 29 years old living in Singapore. If you're interested in personal growth, financial freedom, and getting through life's hardest challenge, you're in the right place. On this channel, I share my journey towards 3 big goals. Firstly, to achieve financial independence. Next, to improve my physical and mental well-being. And lastly, building multiple streams of income. I will be starting a mini-series on personal finance where I will be deep diving into 3 pillars that can truly change your financial life. Firstly, debt. How to clear it fast and stop letting interest eat away your income. Secondly, savings. The most practical ways to grow your savings rate without feeling deprived. And thirdly, investments. How to get started, avoid mistakes, and let your money grow for you. These are the building blocks of financial freedom, and each of these deserves its own deep dive. So, if you have the same goals as me, I would love for you to join me on this journey. Let's dive right in. You can check out the timestamps and skip to the part where it's relevant to you. If you compare purely saving versus investing with inflation, you realize that you're actually losing money over time. For example, if you put $10,000 in a savings account and inflation averages 3% annually, after 10 years, your money will only be worth about $7,000 in today's value. But if you invested that same $10,000 at a 7 to 8% return, after adjusting for inflation, it would grow to around $14,000 to $16,000 in today's value. In 10 years, your savings might lose value after inflation, while your investment could nearly double, even after factoring inflation in. So what exactly is inflation? It's the steady rise in the price of goods and services, which means your money buys less tomorrow than it does today. That's why investing is so important. It helps your money outpace inflation. And the secret weapon here is compound interest. Compounding means your money earns returns, and those returns earns even more returns, creating exponential growth over time. Albert Einstein famously called it the 8th wonder of the world. Now that you understand why investing matters, let's dive into the different types of investments you can get started with. If you're investing for the long term, like retirement, you only need to know a few main options. We'll break it down to the different risk level. Firstly, the low risk type, which are bonds and fixed deposits. These are safe, stable options for medium to long-term investments, but their returns are really low and may not beat inflation. For bonds, it's essentially loans to companies or governments, and in return, you earn a regular interest, which is called the coupon. An example would be the Singapore Savings Bond. It's a government-backed and redeemable anytime without penalty. The pros is that it provides steady income and capital preservation, while the con is that the value falls when interest rates rise, and some bonds can be called early. Next will be the fixed deposits. You place a lump sum with a bank for a set period at a guaranteed rate. At maturity, you get your principal plus interest. The pros is that it's safer than regular savings with predictable returns. The con is that money is locked until maturity, and early withdrawal may incur penalties. If you're open to more risk for better returns, the index funds and ETFs are great beginner-friendly options. An ETF is a basket of stocks that mirrors a market index. It trades like a stock but gives you a broad diversification in one purchase. The examples are STI ETF, which tracks 30 top Singapore companies, and the S&P 500 ETF tracks the 500 of the largest US companies, giving you exposure to the US market. The pro is that it's low cost, gives you instant diversification, and provide you with competitive long-term returns. But the con is that it still moves with the market, so there's no downside protection, and there's no chance to beat the index. It's best for almost everyone, especially beginners. It's a simple low-cost way to invest for retirement or long-term wealth without needing to pick individual stocks. Finally, there are individual stocks, crypto, and speculative assets. When you buy a stock, you are buying a small piece of a company. The pro is that there's potential for big gains, dividends, and more control. But the con is that it's riskier, hard to diversify, and emotionally draining if you track your prices daily. From my experience, stock picking takes time, research, and strong discipline, which is why I don't recommend it for beginners or retirement planning. As for crypto and speculative assets, they are extremely volatile. If I ever invest, it will only be with money I can afford to lose. Always do your own due diligence. The key is not choosing just one bucket to invest in, but figuring out the right balance based on your risk tolerance and financial goals. There are so many myths about investing that stop people from even getting started. So before we go deeper, let's clear up a few of the biggest ones. Firstly, I need a lot of money to invest. But these days, you can begin with as little as $100. Some platforms even let you buy fractional shares. So if a stock costs around $500, you don't need to pay the full amount. You can own like 1/5 of it. When I first started, I was putting around $200 a month into STI ETF just to test the waters. It did well, but after researching more, I realized the S&P 500 was a better fit for my age and risk appetite, so I switched. That doesn't mean STI is bad. You can invest in both, but it all depends on your risk appetite. Another common belief is that investing is gambling, but here's the difference. Gambling is about short-term bets, hoping for a quick win, while investing on the other hand is about long-term growth. It's based on owning real businesses or assets and letting them compound over time. Think about it this way. Investing looks at fundamentals, the company's value, earnings, and long-term outlook. And speculation chases short-term price movements, often fueled by hype, rumors, or technical charts. That's why speculation is riskier. It's about timing and luck, but investing is about consistency and patience. And speaking of timing, that ties perfectly into the third myth. I can time the market. A lot of us, myself included, when I first started out, fall into the trap of thinking I can time the market. I remember watching the S&P 500 soar during the post-COVID boom, thinking, maybe I should wait for it to drop before buying. That wait turned into FOMO, and looking back now, if I had just invested consistently, my returns would have been much higher. The truth is, no one can time the market. Prices are influenced by too many unpredictable factors, like the pandemics, politics, and global events. But over the long run, markets like S&P 500 have shown a strong upward trend despite all the short-term dips. That's why dollar cost averaging is so powerful. Instead of guessing the perfect time, you invest consistently and let time in the market do the heavy lifting. Now that we have cleared up the biggest myths, let's talk about practical investing rules you can actually follow. The first rule, pay off high interest debt and build an emergency fund first. If you're carrying high interest debt like credit cards, you will want to clear debt before investing, because a 20% interest rate will eat up any returns you might get for the market. On top of that, always make sure you've got an emergency fund. Aim for 3 to 6 months of income in a savings account that you can access anytime. This way, if life throws a curveball, you won't be forced to sell your investment at the worst possible time. The second rule, dollar cost averaging versus lump sum. You have probably heard me talk a lot about DCA, investing a fixed amount every month. But research shows that lump sum investing often outperforms DCA over time. Using fee as example, if your platform charges a flat fee, say $1.99, putting in 4K a quarter will cost you 0.05%, which is cheaper than putting in 1K per month, which will cost you 0.199%. Another example is, if you invest 1.2K upfront at a 4% annual return, after a year, you have about 1248. If instead you DCA $100 monthly, you will end up with about 1225. The difference is small in 1 year, but it compounds bigger over time. That said, DCA has one big advantage. It's easier to stick to. Most people find it simpler to budget monthly than to commit big lump sum. So the best method is whichever one you can stay consistent with. Rule number 3, think long term, avoid FOMO and panic selling. If you're investing for retirement or building wealth slowly, the best strategy is to set it and forget it. Stick to something like ETFs and DCA regularly. Resist the urge to check your portfolio every day. Because markets move in cycles, when prices fall, panic selling can lock in losses, but historically, markets recover and grow. Instead, check in every quarter to review your portfolio and rebalance if needed. As you get older or take on more responsibilities like starting a family, you might want to shift towards safer assets like bonds to reduce risk. Now that we've got the ground rules, let's look at the tools and platforms that can actually help you invest. There are plenty of brokers out there, and I won't dive into comparison since you can easily find articles and videos on that. Instead, I will just share what I personally use, mainly IBKR and Tiger. IBKR, Interactive Broker, is my go-to for buying CSPX, which is basically S&P 500 ETF, and for fractional shares. For Tiger, I mostly use this for individual stocks since the commission fees are lower. Why CSPX? It's one of the best S&P 500 ETFs for international investors, especially in Singapore. Because it's island domicile, dividends are only taxed at 15% withholding instead of 30% for US domicile ETFs. Here's my IBKR portfolio. It is still a work in progress as I adjust towards my ideal location. Next will be robo-advisors versus DIY investing. If you are just starting out and don't want to spend too much time researching, robo-advisors are a great entry point. They invest for you based on your risk profile and super beginner friendly. When they first launched, I started DCAing with Syfe and StashAway. But over time, I realized the fees really add up and eat to returns. So the pro is that it's easy to start, low barriers, and no need to pick your own investments. But the con is that the management fees can quietly cut into long-term returns. If you want more control, then DIY brokers like IBKR give you the flexibility to pick your own ETFs and stocks. This can be cheaper, but is also more complex. IBKR, for example, isn't the most user-friendly. I still find the interface confusing sometimes. So with the right platform and rules in place, the next step is learning the common investing mistakes to avoid. The first one is chasing hot stocks. When COVID hit, tech stocks were exploding. That was also when I started diving deeper into investing. I remember buying all the hot stocks I saw people talking about online, like influencers, Telegram groups, and I barely did my own research, so I just followed the hype. It was a huge mistake. Most of those stocks are still down today, and I learned the hard way that hype doesn't equal returns. If you are starting out, stick to ETFs and DCA consistently. It's boring, but it works. The second is to invest money you can't afford to lose. Luckily, the money I put into those hot stocks was money I could afford to lose. That made it easier to move on instead of panicking. If you invest money you actually need, like emergency funds, every market dip will feel like a crisis. Always invest with money you can afford to lose, so it can help you keep calm and help you avoid panic selling. Lastly, not knowing your risk tolerance. Everyone talks about risk, but it's different when you actually experience it. Some people can stomach big swings, others can't. For me, understanding my risk appetite came only after those early mistakes. That's why I think it's worth doing a risk profile test before you even start. It shows how much volatility you can realistically handle. And that brings me to the next part, the mindset shift that makes all the difference in long-term investing. Investing isn't about getting rich quick, it's about building wealth slowly but surely. Real investing takes time, patience, and discipline. Time because compounding needs years to really work its magic. Patience because it's not easy to hold on to your investments when prices swing up and down or when you're tempted to cash out at peak. And discipline because you need to keep investing regularly, even when it's boring. instead of chasing whatever stock or trend everyone is hyping up. At the end of the day, the goal isn't to get rich overnight, it's to give your future self the freedom and security to live life on your own terms. So here's the recap. Saving keeps you safe, but investing grows your wealth. Start small, even $100 works. Avoid emotional investing and focus on the long term. If you found this video helpful, hit like and subscribe. And I want to hear from you. What's your biggest question about investing? Drop it in the comments and I might cover it in a future video. Thanks for watching this mini series and till next time.